So I'm going to pause there. That was a lot, but I think you know I don't have the questions in front of me, but um, I'll pause there for any questions.
Yeah. So our first one reads, I recently found out Strava, the giant, is not profitable according to the CEO. They've gone through multiple rounds of venture capital. How do VCs see this kind of growth-focused, non-profit focused strategy?
Yeah, great question. It's probably more common than you might assume. So I think that there are a couple ways to come at this question, but in general, as I mentioned in those levers and seesaws, venture capital is optimized for growth. So to some extent, the path that you're taking and the ability to grow has to be weighted by profitability. So by that, this is a really important dynamic to understand. If at any point your growth starts to decrease, let's say you go from 3x year over year to 1x or half x year over year, then the expectation is that your profitability should be higher. That should be a push pull. If you can somehow find a way to grow insanely fast and be insanely profitable, fantastic. Let me know how you do that. But they tend to be at odds with each other. And so you kind of have to put your pedal on the gas and grow and or optimize for profitability. So usually the path in which venture capital is taken is when you're really optimizing for growth. And I think though, in today's environment with coronavirus and this economic fallout, people are much more sensitive to the ability to be profitable. So the underlying core facets of the business to where if you pulled back the throttle in a couple of areas, you could quickly and easily be profitable. I think what you're going to find is that in marketplace businesses like Lyft and Airbnb and others, and um, it's harder. You don't have the same margins where you can really pull back enough levers and have still enough left over from your revenue in terms of net income in order to create a profitable model. And that's really why software has been so popular for so long. But I think people, and it's certainly different also. Fund size changes the way you invest and your sort of outcomes and long term. But ultimately, raising venture is a function of speed and scale. And so if you find yourself absolutely needing to grow really quickly in order to capture a market, that's a tactic. And some investors might believe in that tactic and get on that board with you, get on that ship with you. And so it then becomes over optimized for growth as opposed to profitability.
Awesome. And then our second question we have is, how much equity does a startup typically lose when raising angel investment? How much dilution do startups typically lose in Series A investment rounds and onwards?
Uh, yeah, totally. I'll give you the sort of averages, benchmarks, but every situation's a little different. Um, but presumably, you can expect for investors to need somewhere between 10 to 20% in equity for an institutional round of financing. Um, if it's an angel, that can be a very different profile. You have to keep in mind, venture investors have gone out and raised capital from other investors, telling them, "Hey, here's our strategy. We're going to invest in equity, XYZ dollars to get 10 to 20% of a business, and then we want to keep that percentage for as long as we can until other investors come in and we'll pass along and take dilution alongside the founder." And so they've kind of made that promise. That's part of the value proposition and what they're promising their LPs. Angels can be a little bit more flexible. So there's really not a hard number to give you there. Um, but in general, kind of going back to you get what you pay for, if you're looking for a really value add, partnership focused venture investor, whether it's a super angel or an individual or an institutional venture investor, you probably could expect 10 to 20%, and in some cases up to 30. Just depends on later stage, for instance, or what you need to do with that capital if you're buying other people out. So it gets hairier as you get later stage. But I think that those are reasonable numbers to assume.
Our next question is it's more oriented towards the social media market. Uh, it's, will investors be on board with a social platform that is focused on rapid user acquisition and is deferring commercialization to later?
Um, So will investors be on board? I think that at that point you're really thinking about a certain subset of investors that would support that model, and vice versa for you, be experts in growing a business like that and value add on a board or as a partner in building a business like that. So I think the short answer to your question is that it really shrinks the subset of investor base that is a good fit and that makes sense. Um, in today's world, I do, the feedback and color that I get from talking to other VCs is that the um, customer acquisition channels for building a social network in today's day and age, with the way that Instagram, Facebook, and the others are effectively controlling those channels and access, is less attractive than it was back in the days of Twitter and when Fred Wilson and AVC were, USV were building. We're so focused on social networks. So I think it's a tougher market today than it goes back to the 10x improvement. Um, it's harder, I think, to say we're going to completely change the way you think about interacting with people like it did when Facebook and Twitter came out, um, than it is today, where most of the solutions, at least that I see, and I think that most would see, are 3 to 5x improvements over the social networks we have today. So that it just makes it more of a challenge, I think, and it probably shrinks the investor universe a little bit. Because again, going back to that question about profitability, those models are very hard to get to. You really have to acquire enough critical mass in order to monetize that user base.
Okay.
Great,
And then how are we doing on your time scale, by the way? Do we want to move on,
good.
or do you want to take a couple more questions?
Let's do one more, and then I'll move on.
Okay. So our last one is, I want to help young Black women learn how to code. How do I get funding for that?
Um, that's a great question. I think we'd have to have a longer conversation for me to give you a really specific answer. But in general, um, it depends on the business model and the way that you're going to solve that problem. Presumably, it's a coding school or something like that. And I think what would be best for you is go to that levers and seesaw slide and just try to understand um, where you where that business would fall on a lot of those questions. Is it tech heavy or tech enabled? Um, is it a large market that is one size, one person wins all, or is it a great business with a smaller niche service, in terms of the market size, and um, where regional scale, because you might have to build a physical location, can be a challenge, and so you're really not just thinking about all Black women or minority women, but it's those that are in Atlanta or in the Southeast. So I would go back to that slide and kind of see where you fall on that. But the second thing is I would look at others that are doing something similar. So other coding schools and boot camps and maybe it's online, but other ways to teach people how to code and see how they've funded their business. Um, but the customer route is usually the best. And I find that especially if you start that leanly without a physical location, that could be a way where you might be able to bootstrap your way through early days by paying customers. But that's really off the top of my head without having talked too much about your specific business. So I hope that's helpful.